The U.S. economy continued to expand in 2017, with that growth accelerating in the second half of the year. Here to discuss this development and AM Best economic outlook for 2018 is Meg Mulry, a senior economist in AM Best Industry Research Department. And Meg, talk to us a little bit about the key economic indicators and what they're telling us.
2017 actually shaped up to be a pretty good year. High consumer confidence, low unemployment. We saw consumption growth. We saw expansion basically through all metrics of the economy, which was a little bit faster than we expected originally. We expect these to continue into 2018. So far, they've looked pretty good. We expect consumer confidence to remain pretty high and consumption to remain pretty high. And in addition, we have probably some increased business investment with the tax plan, as well as a strong global economy to act as a tailwind.
Now, the labor market continues to expand.
Right.
Unemployment is at a 7-year low, but that hasn't exactly translated into hourly wage growth. What's behind that?
Yeah, this has been one of the big mysteries that we've been experiencing in the recovery. We've had strong labor markets, solid wage growth has yet to really materialize, and participation rates in the labor market have yet to really come back up to what we think would be a better level. So what we're seeing now is in 2017, wage growth was around 2.5%, but in January, actually, it picked up to 2.9%, which was a much faster acceleration of wage growth than we had seen. So what we're hoping is that with wages coming up, we'll see a higher participation rate as people who've been on the sidelines now re-enter the labor market, which will keep sort of a stable wage level as opposed to creating sort of an inflationary environment.
What are you seeing in the way of household debt, and is it a concern?
Yeah, this is one of the things that we've definitely been keeping an eye on. Following the recession of 2007, 2008, we saw households deleverage. They paid down their debt, they increased their savings. And I think in 2008, we have passed the level of debt that was outstanding at that point by about $280 billion, which is a pretty significant increase. And as well, we're about 16% above where the trough was in 2013. So in the last 13 consecutive quarters, consumers have been adding more debts to household, and this is across basically all levels. Household debt included, higher mortgages, higher student loans, car payments, credit cards. And one of the concerns that we have right now is that if the Fed does in fact continue to raise rates, the cost of servicing these debts are going to increase and basically reduce disposable income for consumers, as well as putting more pressure on overall borrowing costs.
Well, let's talk a little bit about the equity markets. A little bit of a bumpy ride in February. How would you characterize the stock market?
Well, if you're looking at the stock market, the best way I would characterize it, in 2007, 2008, there was a point in time where bad news for the economy was actually good news for the market, in that, what the thinking was that as the markets sort of or as the economy continued to contract and had higher unemployment, you would get additional stimulus from the Federal Reserve. We saw quantitative easing, and this all provided a backstop basically for the markets. I think what we've seen in recent days is sort of a reversal of that, where good news for the economy is actually bad news for asset prices, and that the faster that the economy grows and the better that it's doing, the more we'll see the Fed move to normalize policy. And following 10 years of ultra easy monetary policy, the tightening on a strong economy could have, widespread pricing implications for assets across all classes.
Let's talk a little bit more about the Federal Reserve. What do you expect to see out of them in 2018?
Yeah, for the Federal Reserve this year, we're expecting them to raise rates probably 3 times. Right now, the thinking is March, June, and December to end around a little bit above 2% for the federal funds rate at the end of the year. This is obviously very data dependent. Chair Powell has inherited a very strong economy, but there's a lot of moving parts, right? We've seen the tax cuts, we've seen the budget pass, and all of these things are definitely going to be baked into those estimates and in what we're seeing. So while I think that it's a positive economy, we've definitely seen volatility come back, and everyone's sort of trying to figure out if in fact we do get these 3 rate hikes, what the implications are.
You mentioned tax reform there. What do you expect that impact to be?
Well, near term, we think it's going to be a positive, right? Higher disposable incomes due to lower individual tax rates for households, as well as higher investments for corporations due to the fact that there are permanently lower tax rates. Longer term, however, we are concerned about, we're going to keep a very close eye on the fiscal deficit. Estimates before the budget was passed was that the Treasury is going to have to issue about $1 trillion of debt this year. This is going to go up most likely following the $300 billion of additional the 2-year tax bill that just got passed. So this is a lot of extra borrowing that the government's going to have to do. In addition, the Federal Reserve has started scaling back their purchases, and they're no longer sort of a built-in buyer for these assets. So what we've seen is sort of a repricing. So we're going to keep a very close eye on that because, you know, the long-term implications of all this borrowing are going to be pretty substantial. And I think investors are starting to recalibrate their risk premiums as well as term premiums.
Thanks, Meg.
Of course, John.
Senior economist Meg Mulry for AM Best TV. I'm John Weber.